Hi, my name is Justin Cotton. I'm with Trends Capital, and this is the first installment of Trends Capital Do-It-Yourself campaign. Today I want to talk to you about three major pitfalls that most real estate investors seem to overlook whenever they're buying property. And the first one is management cost. Okay, the second one is the cap reserve, and the third one is the vacancy delinquency rate. The first pitfall that I'd like to talk about is management cost. The typical real estate investor never factors in management cost whenever they're evaluating a multifamily or commercial property. Now, I'm here to tell you that your time is worth money, despite what anyone else tells you. Okay. Now, these management costs can be, they can vary from gas expenses to wear and tear on your car to leasing apartments. Now, this all falls under management costs, and it costs you time. And when it costs you time, it costs you money. Now, when I talk about management costs, it's typically 5 to 10% of gross income on the building. So whenever you're evaluating a multifamily property or a commercial property, typically you take 5 to 10% and save that money on the side for management costs. Now this is going to save you time and money in the long run. The second pitfall I'd like to talk to you about is the capital reserve. Capital reserve typically means that you set aside some money for unexpected repairs in your property, multifamily or commercial. Now typically you'd reserve about $200 to $300 per unit per year for the building. And what this does is basically set you a nice cushion for whenever something unexpected happens, such as a roof repair, furnace repair, or replacement. Anything that really doesn't come under the common wear and tear of a building. Okay. Now you can factor in maintenance costs, but the capital reserve is separate from maintenance costs because maintenance cost is typically cutting the grass, taking out the garbage, a repair of a railing, something small, not as significant as a furnace or a roof would be. So whenever you factor in these costs, you end up saving yourself a lot of time and money in the long run because you won't be underwater when these things do occur. Now, the third and final pitfall I'd like to talk to you about is vacancy and delinquency rates. Now, it's great to think that your building would be full 100% of the time, all the time, but the fact is that's naive thinking. Anytime you get into a multifamily property or a commercial property, there's times where you'll need to rent the place out and it's vacant. Okay, so factoring in this 5% vacancy will help you cover the costs while your units are vacant. The second part is the delinquency rate. Typically, investors give 1 to 3% in a delinquency rate. Now, what this means is, it's great to think that, once you get your tenant in, they're going to pay the rent on time every time. But the fact is they don't. We've all come across it, and we all have to deal with it. So whenever you are dealing with one of those situations that's surely to come up, you have 1% to 3% of a cushion to cover you during those times. I wish I was going to end it. Now, this concludes our first installment of the Trends Capital Do-It-Yourself campaign. I hope you found these 3 tips useful, but if you haven't, you're more than likely one of the common investors that I come across every day. If so, please send me your name, your property address, and I'd be more than happy to negotiate a price to get you out from under that property. My name is Justin Cotton. I hope to talk to you soon, and please visit us at pghlandlord.com for more useful tips in our Do-It-Yourself section.